we run a risk that, in terms of terrorists doing a lot of things but we're in the business of taking risks, and we try to get paid appropriate.
Warren Buffett says once, risk comes from not knowing what you're doing. This quote perfectly sums up the biggest challenge facing new crypto investors. But by the end of this video, you'll have the knowledge and tools you need to invest in crypto with confidence and manage your risk like a seasoned pro. Cryptocurrency has been on a wild ride since Bitcoin launched in 2009. We've seen crazy highs like when Bitcoin reached over $65,000 in 2021. But we've also seen painful lows, like when it crashed down to around $17,000. This kind of extreme volatility is super common in the crypto market, and it's one of the biggest reasons why so many new investors get burned. They jump in without really understanding what they're doing, and they end up losing big. So, what exactly is a crypto market cycle? It's basically the time between the lowest and highest prices of cryptocurrencies within a specific period. Think of it like the seasons: spring, summer, fall, winter, but for crypto prices. And just like knowing when to plant your garden or break out your winter coat, understanding these cycles can help you make smart decisions about when to buy or sell your crypto. Now, crypto market cycles have different phases: accumulation, uptrend, aka bull market, distribution, and downtrend, aka bear market. Let's break them down. During the accumulation phase, prices are usually low and there's not much hype. This is when the smart money starts quietly buying up crypto before the masses catch on. Next comes the uptrend or bull market phase. This is when prices start consistently climbing. The media starts buzzing, and more people want in on the action. But be careful. This is when a lot of newbies jump in without really knowing what they're doing. Then there's the distribution phase. The market starts losing steam. Prices might still be going up, but slower. This is when the early birds start selling to take their profits. It's like the party's winding down and some people are heading for the door. Finally, we've got the downtrend or bear market phase. Prices are dropping, trading is slowing, and the mood is pretty gloomy. People who bought during the bull run might start panic selling, which pushes prices down even more. So how can you spot these phases? In a bull market, you'll see prices climbing steadily, lots of trading action, and an overall positive vibe. But in a bear market, prices are falling, trading is sluggish, and the sentiment is pretty negative. Let's look at some real-world examples. Bitcoin hit an all-time high of over $65,000 in November 2021. That was the peak of a major bull run. But by late 2022, it had crashed down to around $17,000. That's a textbook bear market. According to William Prakaski, a finance professor at Texas A&M, new investors should be extra cautious about diving into crypto without understanding how volatile and cyclical it can be. More experienced investors might be better equipped to ride out these wild swings. But even if you're new to the game, don't let that scare you off completely. By educating yourself on market cycles and how they work, you'll be way ahead of the curve. Just remember, as with any investment, never risk more than you can afford to lose. So now that you know how to spot the different phases of a crypto market cycle, you might be thinking, great, I'll just buy low and sell high. Easy money. Well, not so fast. There are some serious risks you need to be aware of before you start throwing your money around. In the next section, we'll dive into the potential dangers of investing in crypto and how to protect yourself. All right, now let's talk about the not so fun part, the risks of investing in crypto. I know nobody wants to think about losing money, but trust me, understanding these risks is absolutely crucial if you want to survive and thrive in this wild world of digital assets. First up, we've got market volatility. And when I say volatile, I mean it. Crypto prices can swing up and down faster than a roller coaster. Just look at Bitcoin. In November 2021, it was flying high at over $65,000, but fast forward to late 2022, and it had plummeted to around $17,000. That's a gut-wrenching drop of more than 65%, and that's just one example. The crypto market as a whole is known for these crazy highs and lows. Next on the list of risks, regulatory changes. The rules around crypto are still a bit of a wild west, with governments around the world trying to figure out how to handle it. And when regulations do change, it can have a huge impact on how you use and access your crypto. Imagine waking up one day to find out that your favorite exchange has been shut down, or that you suddenly owe a bunch of taxes on your crypto gains. It's a constant source of uncertainty and potential volatility. And let's not forget about security issues. Hacks and scams are unfortunately pretty common in the crypto space. And unlike with traditional investments, there's no safety net or insurance if your crypto gets stolen or lost. We've seen some really high-profile examples of this, like the FTX debacle at the end of 2022, the Terra Luna collapse, and the Celsius network failure. These events caused massive losses for a lot of investors. Another risk to keep in mind, crypto is taxable. If you make any money from your crypto investments, you'll owe capital gains taxes on it. That means it can actually be more expensive than just buying stuff with regular cash. And let's talk about storage risks. If you lose access to your private keys, which are like the password to your crypto wallet, you could permanently lose access to all your funds. That's a scary thought. And even if you don't lose your keys, you have to decide between keeping your crypto in a hot wallet connected to the internet, more convenient but more vulnerable to hacks, or a cold wallet that's offline, more secure but less convenient. Exchanges can also be a point of vulnerability. These platforms hold a lot of users' private keys, so if they get hacked, a lot of people could lose their crypto. It's a centralized point of failure. And here's the kicker. As Professor William Prakaski bluntly put it, crypto failed the test as an inflation hedge. If it's possible to give it an F, that's how it performed. Ouch. So much for being a safe haven during times of economic uncertainty. But wait, there's more. Unlike traditional investments, crypto is not insured by the FDIC or SIPC. So if something goes wrong, you're pretty much on your own. So to sum it up, volatility, regulatory uncertainty, security risks, taxes, storage dilemmas, exchange vulnerabilities, and lack of insurance. It's a lot to take in, I know, but don't let it completely scare you off. By educating yourself and being smart about how you invest, you can navigate these risks. Just remember, never invest more than you can afford to lose. So now that we've covered the potential pitfalls, you might be wondering, is it even worth it to invest in crypto? How can you make sure you're not just gambling with your hard-earned cash? Well, that's where risk management and doing your due diligence come in. In the next section, we'll explore some strategies to help you invest smarter, not harder. All right, so we've covered the risks. Now let's talk about how to manage them. One key tool is the risk-reward ratio, or RR ratio for short. This helps you balance the potential upside of a trade with the possible downside. Ideally, you want a ratio where the potential reward is much greater than the risk. Many traders aim for a 1.3 ratio. To calculate the RR ratio, you'll need to define your risk, the difference between your entry price and your stop loss, and your potential reward, the difference between your entry price and your take profit level. Then just plug those numbers into the formula. Risk-reward ratio, MON, entry price, stop loss, take profit, entry price. Don't worry, platforms like TradingView can do this math for you with just a few clicks. But remember, a good RR ratio alone doesn't guarantee a successful trade. You'll want to combine it with other types of analysis and indicators to get a well-rounded view. To really use the RR ratio effectively, you need to know your own risk tolerance, set realistic profit targets, always use a stop loss, and keep a close eye on your trades. Common mistakes include ignoring proper risk assessment, setting unrealistic goals, skipping the stop loss, relying solely on the RR ratio, letting emotions drive decisions, and forgetting about transaction costs. Now, let's talk about doing your due diligence on a crypto project before investing. Is the project's white paper. This is where the developers lay out their vision, timeline, and the nitty-gritty details. If a white paper is light on specifics and data, that's a red flag. Another smart move is to do a test transaction before going all in. Send a small amount of the crypto to a test address first to make sure everything works as expected. When it comes to your actual trades, always set realistic profit targets and stop loss levels. This helps take the emotion out of it and automates your risk management. Remember, even with a great RR ratio and solid research, not every trade will be a winner. But by managing your risk and doing your homework, you tilt the odds in your favor over the long run. So to recap, use tools like the risk-reward ratio and TradingView. Always read the white paper, do test transactions, and set those profit targets and stop losses. It's not about hitting home runs every time. It's about consistently making smart, well-researched trades. That's how you win the crypto investing game. Well, we've covered a lot of ground here. We've explored the wild ups and downs of crypto market cycles, the potential risks that come with investing in this space, and some key strategies for managing those risks and doing your research before diving in. The bottom line is this: knowledge is power. The more you educate yourself about crypto, the technology, the market dynamics, the regulatory landscape, the better equipped you'll be to make smart, informed decisions about your investments. So keep learning, read those white papers, follow the news, and don't be afraid to seek out professional advice when you need it. Because at the end of the day, investing in crypto is not about getting lucky or following the hype. It's about understanding what you're getting into and having a solid plan. If you want to dive deeper into any of these topics, be sure to check out my video on Bitcoin Halving. It ties in nicely with our discussion of market cycles and price predictions. Remember, crypto is an exciting frontier, but it's not for the faint of heart. Arm yourself with knowledge, stay disciplined with your risk management, and always keep your long-term goals in mind. That's how you'll thrive in this wild world of digital assets.